Why don't revenues and expenses simply equal the cash received or paid? In this video, I introduce accrual accounting and explain how it handles timing differences between cash flows and economic activity. This is the fourth video in the series that introduces the basics of financial reporting of the balance sheet and the income statement. The first video introduced overall the financial reporting structure as well as the repository of the filings, the SEC Edgar system. The second video introduced the balance sheet. The third video introduced the income statement. And in this video, we're wrapping it up by really highlighting the differences between the timing of cash flows and the timing of economic transactions and how those things influence both the balance sheet and the income statement. Let's start by pretending that things are very simple. Let's imagine a firm where economic transactions are not disconnected with cash. They are perfectly aligned, they're coinciding with the cash inflows and outflows. Here's a scenario. Let's say that we have a company called Alina's Cleaning Service, and it sends a housekeeper to a residence, collects $100 as payment immediately, and also immediately remits $60 to the worker. In that situation, everything is really easy, right? We know what the income statement is going to look like. On the revenue side, we have $100. On the expense side, we have $60. The profit is $40. We don't really have any assets or liabilities to worry about because the only thing that happened is the cash also went up by $40. Everything is really aligned. And if this is kind of your mode of operations, then you don't need to worry about accrual accounting. Cash basis of accounting is totally acceptable. But for big firms, for public firms in the United States, that is simply not how they run their business. The timing of economic transactions typically does not coincide with the timing of the cash inflows, and they cannot show their income statement on the cash basis. They must show it on the accrual basis of accounting. Accrual is kind of a big word, but really the meaning is quite straightforward. It means that we need to show transactions and events in the periods in which occur, regardless when the resulting cash inflows or outflows actually occurring. So even if we have the disconnect between when the economic event happens and when cash exchange occurs, on the income statement, we follow the timing of the economic transactions. And that means that even if we got cash today, that doesn't mean we recognize the revenue today. It could be that we have already recognized previously the revenue. It could be that we're going to recognize it in the future. Same thing, just because we're paying cash today does not mean that we recognize an expense today. We could have recognized an expense in the prior period. Possibly we're recognizing an expense in the future. Let's take a look at a couple of very typical transactions that companies might have and how they're going to be spread out across multiple fiscal periods. Again, accrual income will reflect economic activity and it won't measure cash exchange. It will measure net asset inflows and outflows. If you remember the discussion of net assets from video 3, net assets means assets minus liabilities. So your net assets going up means maybe an asset went up, cash or another one, or maybe a liability went down. Net asset going down could mean that an asset went down or a liability went up. Both of those are possible. And that doesn't necessarily correspond to cash. Let's start by thinking about sales. So we have this kind of very rudimentary timeline. We have some prior period, current period, and future period. The items that are in blue boxes are all economic transactions, and the items that are in green boxes are the cash exchanges. So what are some possibilities? Here's an example of transaction. The company is selling the goods on account today. On account means that I have done my work, but the customer doesn't pay me immediately. I'm going to send an invoice and then collect the payment. If I'm selling the goods today, then the economic activity happens in this period. It would be reflected on the income statement, even if the cash collection is going to occur in the future. Of course, the flip side of this transaction, it could be that this period we are collecting the cash for the economic activity that already occurred in the prior period. Maybe we have provided a service in the prior period. That's when we recorded the revenue. We send the invoice and we're just collecting the cash today. It could be that we're getting a cash deposit from a customer today, but we haven't done the work yet. The work will be done in the future period. So if you think about examples of companies from Johnson & Johnson to Raytheon to Tesla, most of them, they do have this disconnect in one direction or another direction in terms of when they're actually doing the work and when they're getting paid from their customers. Same thing with the expenses. Let's say that the company purchased inventory last period, but they're only selling this inventory to the customers this period. So the cost of this inventory would only be reflected in this period on the income statement because that's when that cost helps to drive the revenues. Let's talk about insurance. It could be that the insurance is prepaid in the beginning of the year, but the firm is actually covered by insurance throughout all of the periods, the entire first quarter, second quarter, third quarter, etc. The economic event spans a much longer window. So we're going to talk about examples like that in future videos as well. It could be that we took out a loan, and while the loan is outstanding, the interest on the loan is accruing and it's growing, and we're only going to pay the interest together with the principal at maturity. These are just some examples, but pretty much almost any transaction that you can think of for a large public US company, that transaction is almost never going to be of nature where the cash coincides immediately with the economic event. There could be some transaction where that separation is not very long. So, for example, for workers, typically the paychecks are maybe 2 or 3 weeks separated, but you don't normally have a situation where you don't pay your workers for months on end. So there's a bit of a separation, but maybe most of it is still within the same quarter. But a lot of other situations, that separation could be longer. If we're not tied to the receipt and payment of cash, what is going to be the driving factors that determine when we put something onto the income statement? So let's talk about revenues first, and then we're going to talk about expenses. For revenues, we have these two primary questions that need to be true in order for us to recognize revenue. First of all, we need to have a revenue that's realized or realizable. It means that we expect a payment at some point. The net assets need to increase. A liability needs to be satisfied or an asset needs to be received. We'll get into more detail of this when I do a series specifically on revenues. But typically, if you're doing business with a customer, you expect to be paid. That's kind of, not a concern. The big question is, has the revenue been earned? The seller has completed the duties under the sales agreement. So you can only recognize revenue when you've done the job. Even if you already got paid by a customer, if you did not do your work, you cannot recognize revenue. Now, a little bit of a side note, if you're at all familiar with accounting regulation, you actually will recognize that this language, the two criteria, reflects older conceptual language that we used. We now have a new rule that has this new regulatory 5-step process. I will go over that in a video specifically on revenue recognition, but the intuition is actually the same. The intuition remains. Our two main criteria, the way of thinking about sales is, have I gotten paid or do I expect to get paid? And very important, have I actually done the job? Now let's talk about the expense side. When do we recognize the expenses? Let's take a step back all the way to the first video that actually introduced the idea of the financial statements, and the second video that introduced the balance sheet and the fact that companies all want to achieve some strategic plans, and in order for that, they need resources. So they're spending money to acquire resources. Now, the question is, when company is incurring a cost, when they're spending money to acquire the resources, do they receive a benefit immediately in the same fiscal period? Or is the benefit from those resources going to come in the future? Sometimes we have situations where the benefit is in the same fiscal period. If I am paying my telephone bill for my workers for this quarter, this doesn't really have a future benefit. This benefits me today. This is something that I'm using up this resource, access to the telephone service today. That's going to be recognized immediately we're going to have an alignment. The same period when we actually spend money on this resource is when we're going to recognize an expense. However, we have a lot of situations where this expenditure today is not benefiting us immediately. It's going to benefit us at some point in the future. So for now, what happens to this cost? It kind of takes a scenic route. It takes a detour. So first it gets recognized on the balance sheet as an asset. And then when we actually benefit, then it gets recognized as an expense. Inventory is a simple example. When we are buying inventory, the moment that we purchased inventory, has that inventory benefited us? No, it hasn't. It's sitting in a warehouse, not really doing anything. So until you actually sell it, until it benefits you, it sits as an asset on your balance sheet. Only when you actually sell it, that's when you recognize the benefit. That's when you move it from being an asset on the balance sheet to being an expense called cost of goods sold. Essentially, we have three types of expenses. So all expenses are going to be recognized in the period when the net assets are used up. That will generally align with helping us drive the revenues. So we have three basic groupings of expenses. One are product costs. Sometimes we can directly link that a certain activity helps us to generate the revenue. The inventory, that's kind of the most obvious one. When do we recognize the cost of inventory? When we sell that inventory. It's very, very direct. It's linked to a specific product as it moves into the customer's hands. The next one is period costs. We have situations where we cannot really identify how this benefits us to a particular sales number, but we know it benefits us in general. So think about rent, utility, advertising. Even though there could be benefits in the future, you just treat this as operating expenses in the period where these are incurred. And the third one is systematic allocation. This is depreciation that we're going to learn more when we do our video on adjusting entries, which is just a couple of weeks from now. I expect to put that out. Systematic allocation is when you have a cost and you expect that cost to help you to generate revenues kind of in a somewhat smooth fashion over multiple periods in the future. So for example, you buy a truck, that truck will help you to generate revenue for the next 5 years. You buy a building, that building will help you to generate revenue for the next 20 years. Correspondingly, you're going to allocate the cost of that truck, the cost of that building over multiple periods as you are using them up. Again, some we're able to directly link to revenues. Some we assume just kind of happen in a certain period and don't carry over. And some we allocate over a number of periods. Accounting is a lot about language, understanding concepts, getting familiar. So it's a little bit like a foreign language where the first you dive into it, it's a lot of terminology that you don't know, and then you make sense of it. Sometimes it seems more complicated than it is. Here's an example. The words accrual and deferral. It's not a word that I use every day, but fundamentally, accruals and deferrals are actually a very simple concept. It comes down to the fact that the timing of the cash exchange does not match to the timing of the economic transaction. Sometimes we have a situation where the economic transaction is rushing. So our little bunny over here, the economic transaction occurs first. It is in a rush. We have things that are hitting the income statement before the cash is received or paid. For example, if you have an expense that hits the income statement, but you haven't paid it yet, guess what? You have a liability. So some workers worked for you, so you have a salary expense, you haven't paid them yet, you have a salary payable. If you have an accrued revenue, that means that you have some sales that were recognized on the income statement before you received the cash. We call this asset an account receivable, very normal transaction. So accrual just means the income statement is rushing. And when the expenses are rushing, that leads to liabilities. And when the revenue is rushing, that leads to assets. What about deferrals? Deferrals is when the income statement is being slow. The income statement is a little bit of a turtle. So we have the cash transaction that happens first, and then the income statement recognition catches up later. If we have deferred expenses, that means that we have already paid for something and we have an asset until we use it up. For example, prepaid insurance. The cash exchange already happened, but the insurance expense is going to be recognized slowly as time actually passes. What about a deferral of the revenue? That means we have already received the cash from a customer, but we haven't done the work yet. So we have a liability called deferred revenue. So those words, accrual and deferral, just means accruing or rushing income statement recognition or deferring, slowing income statement recognition as compared to when the cash exchange actually happens. We have now wrapped up the first batch of introductory videos and received the basic grounding into the balance sheet, the income statement, and how to navigate the financial reports of U.S. public companies. In the next several videos, I will go through examples of very common business transactions, and I will show specifically how they impact the accounts on the balance sheet and on the income statement. From then on, I will move into more topical videos. I will have specific videos about accounts on the balance sheet, accounts receivable, inventories, and the income statement accounts, and I will get into those details. The expectation is that the videos will be released twice a week on Mondays and Wednesdays, and on most Fridays, there will be a Footnote Friday episode, which will be a little bit different, probably shorter, a little bit about current events, deep dives into 10Ks, and other topics. Hopefully you enjoyed it. Please like, subscribe, and share it with your colleagues and friends, and I will see you in the next one.